Welcome to Real Estate Today with Yvonne Candy. Learn how to invest in today's residential and commercial real estate. Get informed and get the latest news and trends. Whether you're an investor, home buyer, or homeowner, or just want to be entertained, you're in the right place. And here's your host, Yvonne Candy.
Hi, everyone. Welcome to part 2 of Credit Repair Secrets. I don't know about you, but I like to learn as much as I can about credit because I know if I have good credit, I have leverage over my finances. Bad credit can hold you back in life and close the doors to many opportunities. Today we have back on the show owner of Credit Education Consultants, Laurie Zoock. Laurie is here to teach us more about the credit industry and what you can do to improve and build your credit. Welcome back, Laurie.
Thanks, Yvonne, for having me back.
Laurie, exactly what FICO scores mean and why do we have so many different ones?
Well, the reason that there are so many is because there are different industries use different FICO scores, which use slightly different algorithms. And so they can be slanted different ways depending upon the industry. So, for example, there is a mortgage FICO, there is an auto finance FICO, an insurance FICO, a credit card lending FICO. So each one is a little bit different. FICO also, that's how they make their money, is by selling these different scores that are meant to predict risk in different situations.
What exactly is FICO?
Well, FICO stands for Fair Isaac Company, which I believe has been around since the 1970s. Mm-hmm. What was happening was that banks wanted lenders wanted a more predictable way, but it's all automated via computer. So basically, your credit is now registered through each of the three bureaus, and that's a little confusing too because you can have a credit line that only appears on one or two, and maybe not all three. It depends. But FICO created it to assess risk and determine what your credit worthiness was. Unfortunately, they don't reveal much about their secret algorithm. That's why it's a secret. But they do have different software versions that I know are used for different types of lending.
Now, is it possible to have the same credit score on all three bureaus?
Well, I've been a credit consultant for 12 years, and I can tell you I've only seen that ever happen one time. The chances of that are slim because I believe what FICO does is with each credit bureau, TransUnion, Equifax, and Experian being the big three, may slightly modify them to whatever it is that they're looking for. Again, they keep it a secret. So it's highly unlikely that you're going to have all three be the exact same number.
Now, I hear people say it isn't a FICO score, so tell me, what's the difference?
Well, the credit bureaus actually created Vantage scores. So it's a different type of scoring model. Now, I'm not familiar personally with anyone who uses Vantage. I know that some lenders, credit card companies landlords may use it, but it's not all that common. It's not widely used. I can tell you that people who use Credit Karma, that is using Vantage scoring. And so, for example, when you are applying for a loan for a house, you are getting a FICO mortgage score. But on Credit Karma, people don't know there are all these different scores on FICO. Most of them don't even know there's Vantage score. So when they go to Credit Karma and they pull up a score, in their head they're thinking, well, this must be my FICO score. It's not. If you look at the fine print, it's actually a Vantage score. So it's not that widely used.
So that's why you don't see FICO on Credit Karma.
Nope, and it's actually the number one question I get asked when someone calls me is, how come my score on Credit Karma is not the same as the mortgage poll? Why aren't they the same? Because if you have low scores on the FICO, the Vantage scores actually may appear higher, and people get excited. They go, wow, I have a 700 score on Credit Karma. But then the lender pulls the FICO mortgage score, and it's 650, and then they're crying, what's wrong? The one thing I can tell you that I do know is that if you have high FICO scores, most likely you're going to have a high Vantage score. But the lower it goes, the bigger a difference there is between the two scores.
Yeah, I know someone that went to the bank to get a loan. Before they went, they had checked their Credit Karma. And they're saying, oh, wow, I'm good. I'm up like a 660 or whatever. And as soon as
Right.
they got to the bank, it was like under 620. I couldn't believe it. I'm saying, are you serious? What are they
Oh, yeah.
doing? What are they using to get this score?
Right. And let me tell you something to make the situation even more complicated. Okay, a lot of people order their annual creditreport.com, once a year, and they get the reports, which are very difficult to read. And you can order your FICO scores from each of the three credit bureaus, but you ready? The score that you're getting is a consumer FICO score. A consumer FICO score means absolutely nothing. It means nothing. Nobody is using a consumer FICO score. So my guess is they're probably just averaging out, all of your multiple FICO scores into what they call a consumer FICO score. When you go to a specific lender or, for a specific purpose, like I said, auto, insurance, mortgage, they are using a software version that pulls for whatever FICO, brand they're trying to pull for that, and it's going to be different. A whole bunch of scores.
It is. It is. And when you go on Experian, like I had said in a previous episode, they do give you the different FICO scores. But what do you do if you're going to get a loan, whether it's a mortgage, a personal loan, credit card, auto loan? You think you should ask them first what credit bureau they use? And also, Laurie, do you think that you should ask if they use Advantage or if they use FICO?
Yeah, you could ask them which one they use. I'm going to tell you probably the majority are going to say FICO. If you are applying for credit, now here's where it gets tricky. If you're going for a mortgage, they're going to pull a mortgage FICO score and drop the highest number and the lowest number, and they'll use the mid score, the middle score, to qualify you for a loan. However, if you're going, for example, I'll give you what I do. When I go to buy a car or lease a car, I go to myfico.com, which of course is owned by FICO, because I want to see what it's showing on my FICO for each of the three credit bureaus. Now, most car dealers use Equifax to qualify you, but I do know it's possible. In some cases, some dealers will use whoever you have as the highest score, because if, for example, Experian was your lowest score and TransUnion is your highest score, you might want to ask that lender, can they use TransUnion as the highest score? And some won't. But I always show up to the lender with a copy of my FICO before they pull my credit. So they have some idea of where I stand, and I have some idea by speaking with them what my interest rate is going to be.
Right.
That's how I do it. I've seen it occasionally. I'll get a copy of a client's credit report, and it will only show two of the credit bureaus and not the third one. And sometimes I've seen it where it shows one and not two. Now that could be for one of a couple of reasons there. One, the person just doesn't have a lot of credit, and maybe they only have a couple of accounts, and they're showing up on TransUnion, for example. But the other problem is that the third-party company that the mortgage people use, and there are different companies that they use to pull the credit, sometimes there's an issue. It could be a merged file. It could be an identity theft issue. It could just be something not quite right. And in that case, the client has to actually call those credit bureaus, or the mortgage person can do it, and see if they can, clarify what the actual issue is and get it to report. Because if you have major credit cards and, you have good credit, you should be showing up on all three bureaus.
I have had a situation happen to one of my clients like that in the past, and they had to call the bank and get them to report on that credit bureau. It wasn't showing up. So sometimes I guess you have to follow up on these things.
Yeah, and in that case, you bring up a good point. In that case, it may have been a typo, may have been an error, because it's an automated system that these companies use. So somebody may have just forgotten to type in the third credit bureau, and that's why it didn't show up. But if you caught that, that's great, and it's important, because, again, if they're applying for a mortgage loan, that could be the one that's missing, could be the mid-score. So that's a key thing. That's very important.
I think another good question to ask when you're going to apply for any type of loan, especially for those who are trying to build their credit, which credit bureaus do you report to? Because some institutions only report to one credit bureau.
Right, that's correct. And so when you are applying for credit, like I said, most major credit cards report to all three bureaus. They'll report good credit, they'll report bad credit. Store credit cards, for example, most of them are through major. I'm talking like the mom and pop stores or, gas cards. They may only report to one bureau or two. And because those companies pay to subscribe, they don't necessarily pay to report to all three. A smaller company might only report to one or two of those bureaus. And one other thing that you're making me think of is an example of utility companies. They only report negative credit. They don't report any positive credit at all. And that's an issue because I've even challenged Verizon Wireless myself many years ago saying, hey, the Fair Credit Reporting Act says you should be reporting, since you report to the bureaus, you should reporting my good credit. And I went all the way up to the president of the company that time, and they said, well, we don't subscribe to do that, therefore we're not going to, and we don't have to.
Is there such a thing as alternative credit? Let's say if I'm going to apply for a mortgage and I have no credit at all, is it a way that they can get credit from like a telephone company, a cell phone bill, in other words? I know you said utility bills, they only report bad stuff, but can you get them to report anything positive? Maybe if you're on some sort of payment agreement. Cable companies.
Not as far as I know for the utility companies. However, there are companies out there that will report, they're separate from the bureaus, that will report to the bureaus for you if you are making rent payments, for example. I know there are companies that will do that. If the person has no credit, the easiest way, of course, is to try and become an authorized user, within a family member or a spouse's or significant other's card, where they're not obligated legally to make payments, but that authorized usership by that person using that card will add their credit line onto that person's report and start reporting positively. And as long as the other person who holds the main card, makes all the payments on time and pays everything off, you're good. But if they make a late payment, it would affect their credit. There are companies out there. I know there's one called affirm.com. Now, I have sort of a mixed reaction because I look up and do due diligence on companies, and I see that, there's some positive feedback, there's some negative feedback. And so there are companies that will allow you to develop credit because they will report to the bureaus, and you have to ask if it's one, two, or all three. But usually you have to purchase certain items or from certain stores, for example. And, of course, they are going to charge a lot more in interest rates. But if you are trying to develop credit and you have none, that's what you have to do it. You have to do something in order to develop positive credit.
I've heard of those stores. Boy, it's been a long time since I've heard of something like that. It's not a major store, but you can buy a little something and they will report to the credit bureaus and give you credit. I think they're a little bit more expensive. Right. Like you said, they're a little bit more expensive than the norm, but I guess it's a way to build credit, like getting a secure credit card or anything like that. And some of them are secured. Now that I think about it, they're like store cards, online store cards, and some of them are secured in some way, or they charge you a fee or something. I don't remember exactly, but I have heard of it.
No, and you're on the right track with that because you can apply online for secured credit cards. However, I've seen them charge as much as $150 for the privilege of having a secured credit card because you have bad credit. You are better off trying to get a secured card through your bank or your credit union, for example. Now, if you have low scores, and by low, I'm going to say below 600, a lot of banks and credit unions will deny you. And truthfully, I've seen people have a better shot with low scores at credit unions than with banks.
Right. What would you say, Laurie, is a good mixture when someone is trying to build their credit? What would be and how many items do you think they should have on their credit report?
That's a very good question. I actually have a lot of information on that. And when people apply for cards, I'll tell you for me first. Okay, I have two major credit cards. I've had them for about 15 years. Because I know that if I cancel them, remember, like I said, it'll be a big, substantial hit to my credit report. So I have two credit cards with perfect payment history, never been late, usually pay them off. The most I usually recommend is 3. Now, I know that if I add a third card, I'm already over 800, so it's sort of a moot point because once you're at 780, that's pretty much platinum with any lender. But for me, it can be kind of a game, so if I wanted to add a third credit card, it might get me up to 830. But I recommend 3 major credit cards. I do not recommend the store cards, and I want to explain to you why. When you're standing in front of one of those major department stores, they have a little table out there, and they say, hey, 10% off today if you sign up. Or it might just be, a local store. 10% off, sign up today, fill out the application. Well, you do that, they're going to run your credit. It's going to take a few points off your score. But let's assume that you do get that credit card, and it's 10% off your purchase. Well, people go crazy. They think, wow, 10% off my purchase. If I spend $1,000, I save $100. That leaves me with $900. Most people, Yvonne, they don't even have any clue what the interest rate is on that card. They don't bother to even ask.
Right.
And so what happens is, if the interest rate, let's say, is 15% on the $900, well, keep in mind, these companies have actuaries, they have accountants on the other side that have already figured out all the statistics as to how much money they're going to make on you on that $900 that you just spent, because they know that most people aren't going to go home and pay off the $900. They're going to let it stay on their report for a long period of time, or on their bill, and they're going to be paying that interest rate. And most people don't look at their credit card statements, which actually show you how much you're paying in interest each month. These are things people don't even look at.
Right.
These are all the things that I do look at, and I'm sure you do look at, because you want to know, what am I paying to these companies? So in the end, on that $900, if you don't pay it off for 3 years, well, let's just guess. It might be $1,500. It might be $2,000. So did you really save 10%?
Yeah, one of the things that I look at, Laurie, is the purpose of the credit card. What do I want to use this credit card for? Do I want cash back? Do I want to get some sort of traveling points? I think these things are important. I don't think anyone should just get a credit card to get a credit card. I mean, that's all in all fine. When you're trying to build credit, I guess you get what you can get. But
yes,
it's important to also know how that credit card can serve you. And you should also remember that at some point you can always ask for a lower interest rate. Because I have done that, and they have given me a lower interest rate. Some of these credit cards are 24%? I don't know. But if you want 19%, you can call them up and you can say, look, I'm paying 20% with so-and-so, and I want the same, with your company. They are more likely to do something like that when you've been with them for a while. You have a good credit history. I have seen that happen.
Yeah, and the other thing you can do while you're doing that is ask them, can they increase your limit? Because the higher the limit that you have, the lower the usage that you use, the better your scores will become. So you made a very good point.
I think it's 30% or something like that. I always have told people. I always told people like 20%.
Oh, okay. I know what you're talking
20%
about. Okay,
of the credit limit. Yeah, of your credit line.
So,
okay.
Let me tell you about that, because it's different on every website that people read.
Mm-hmm.
I read 35%, 30, 25%,
right.
20. Okay. Normally, unless you're applying for a loan like a mortgage or a car and you want your scores to be up a few extra points, you pay everything off because you don't want to pay any interest rates. But believe it or not, some of these mortgage companies run simulation programs. And so, I had one of the mortgage people I work with sometimes will send me a simulation. And what's happening is, if you only owe $5, that's what I tell people. Owe $5 on each credit card 60 days prior to a loan. Now, of course, you've got to pay off that $5 minimum payment, so you got to kind of time it. So you want to stay around $5, I would say not more than 10. Forget about the 30% and the 20% and all that. To get the highest scores, just owe a few dollars before you're applying for a loan. Once you've qualified for that loan, then go back to paying it off every single month and owe no interest.
And, a lot of people are saying, okay, why did they give me a $2,500 credit line and they don't want me to have any balance on my credit card? Well, they want you to use the money, definitely, but they want you to pay it back quickly. So,
right.
If you can just keep that in mind, that when you use it, you're going to have to pay it back. So don't spend a lot of money on your credit card if you can't pay it back the next month. But always maintain, and this is what I tell my people, to always maintain some sort of payment history and keep everything under 30%. I've even told people 20% just to scare them, because once
that's what you have to do. You're right.
Yeah,
that's
just
exactly what you have to make it a little stricter, and so you scare them a bit so they stay there.
Right.
Hopefully they're going to stay there. Exactly.
Tell them 30% and they'll wind up going to 40%. So, I would say 20% of whatever they give you, that's where you have to stay. And then the second question is exactly why did they give me if I can't use it? So if you're trying.
It's for emergencies.
Yeah.
It's for emergencies.
Oh, it's a wonderful
have an
thing.
Emergency. Yeah. You should have an emergency fund, in the bank, and you shouldn't have to put yourself in that situation. But there are times, obviously, when a situation is going to arise and you may need that $2,500. And you forget about the credit score. You could have a medical emergency,
Sure.
In a situation like that. Yeah, you want to have something like that.
Oh, it's a wonderful thing if you have a family emergency and you can just jump on the plane at the drop of a dime, and be where you have to be when you have to be there. My daughter is in Las Vegas right now, and she has some things that she has to take care of. And I'm saying, wow. And she says, Mom, I may need you to be here to, help me with this business, to support me, to, intervene and what have you. And I says, okay, I can get on the plane. I'll use one of my credit cards and I'll get on the plane the first of the year and I'll be there. It's a wonderful thing when you can do that. And not only that, when you have good credit, you never know when an opportunity comes by. And look, you need a few dollars, you got a credit card. I have bought a house.
Right.
This is the honest to goodness truth. I have bought a house with credit cards. Now, I'm not suggesting that to a lot of people, but I had a plan in place on how it was going to be paid back. So
that's the important part. You and I are planners and look at that kind of thing, as opposed to people who are just reckless or impulsive and have no plan and then end up with 10 credit cards, all maxed out, wondering why their credit scores are so low. And not only that, if they have 10 credit cards maxed out with good payment history and they cancel any of them, then of course it's going to be points off. But it also tells a lender, hey, look, this person has 10 credit cards and they're all maxed out. That's a lot of money. They're not such a great risk. So everything that you're pointing out, I think they're all good points. And when it comes to developing that perfect credit profile, I want to talk a little bit about installment loans, if that's okay, because typically you only need 1 to 2 installment accounts. Now, an installment account is a mortgage. It's a student loan. It can be a car. Sometimes it's a jewelry store or a furniture store. A lot of them do installment loans. And so if you have 1 or 2, that's fine. What most people don't realize is when you pay off that installment loan, your scores drop because you're no longer utilizing FICO. So this, you can see where this is sort of like a jigsaw puzzle. You got to have little pieces and you have to know how they all fit together. The most dangerous thing I see as far as score dropping is when someone has a student loan, and they don't have one student loan. They get one student loan every quarter. And so what happens is they'll have 10 student loans, 20 student loans I've seen, owing thousands of dollars. Well, those are each separate credit lines. And so what I do is I actually have someone that I send them to, or they can do it themselves, and they consolidate them into just one account rather than have so many installment loans dragging the scores down. And so, here's another example. I had a client who was a real estate investor, and under his personal credit, I think he owns 23 homes. They were all tied to him personally. So that was 23 and I said, the only way I can help you get your score up is you're going to have to talk to a lawyer. You're probably going to have to form separate LLCs and get them out of your name and into these LLCs, as for business credit. Also, it protects them liability-wise. So it took him a couple of years because it's expensive to do that. But now his scores are much higher because he doesn't have all 23, accounts that are all homes on the personal part. And again, there's a lot of liability if you own the homes personally as opposed to, put into an LLC or a trust.
Yeah, not to get off track, but I've heard of two different ways that people have done that. One was to have an LLC for every property.
Right.
And the other, I knew someone that had, I don't know, it could have been like 60 LLCs, and each LLC had a property in it. So you can have as many as you want. There is no limit. And another way that I've heard is people using blanket loans. So they put so many properties in one loan. And a blanket loan actually means that it's covering more than one property. So if you have 10 or 15 or 20 properties, you can actually get a blanket loan for that. I think that also cuts down not so much as the personal risks, but it cuts down your ability to borrow because now you have one loan instead of 20.
Right.
So
right.
At
exactly.
any rate, I would prefer if someone was going to do a blanket loan is to have that blanket loan maybe put in a business name if possible, maybe like an LLC, but it's better to have your properties separated. I wouldn't put too many properties in one loan in the first place because that's, if something happens, then you could lose too much.
Exactly.
Yeah, you can lose too
much. That's it, the liability. That's where you have to talk to a good attorney, a qualified attorney, and ask them a lot of questions about that because there are also tax implications, too, on how you do it. So that's a good point. So, in talking about developing the perfect credit profile, I tell people really you only need 3 major credit cards. Don't bother with the little ones. Just start. Hopefully you can get 3 unsecured, but you may have to do secured. 1 or 2 installment lines. That's all you really need. Now, part of FICO, they say that 10% is applying for credit. It's actually new credit. So what I tell people is only apply for credit once a year. If you don't need it, you really don't need to apply for credit at all. Because if your scores are high, it's not really going to affect you to apply for credit once a year.
People don't realize how hard inquiries can take an effect on your credit report. And a lot of lenders will not lend you anything with a lot of inquiries.
Right. You look desperate to them because when they're assessing it and they're looking through your report manually, they're going, wow, look, this person has 20 inquiries. They must really need the money.
Right.
And when they see those credit cards maxed out, wow, this person does not have responsible behavior in making payments back on time. And again, depending on where their scores come in, because keep in mind, these companies are in business to make money off the interest rates they charge people. So when someone qualifies for a mortgage at a 620, they're going to be paying more interest than someone who has an 800 score.
Now, so in other words, you're saying that maybe about 5 items on your credit report should be sufficient to build credit?
Yep. That's really about all you need because length of history is about 35%. Your payment history is 35% The length of credit history is 15%. So, and how much you owe is 30%. So FICO doesn't give the exact algorithm. They just kind of give you a pie chart and say this is what this means and that is what that means. But most people don't really understand how it works. And so, obviously the lower the interest rate, the less money you're going to pay. And the higher the interest rate, the more money you're going to pay. So there's a very good website called bankrate.com that has an amortization schedule. So if you're going to buy a house, it lets you say, plug in, hey, you're going to put in this much of a deposit. You can put in what you estimate, or you can try different interest rates and whatever the dollar amount of the house is, and it will spit out what your monthly payments are and how much you're paying over the long term. So when I went to buy my first house, I used their amortization calculator to figure that out. Also, bankrate.com is a great site for comparing credit cards. So they will tell you like which cards are good, which are loyalty cards, which ones are cash back, which ones might be good for low credit. So it's just an excellent site with a lot of good information.
Great.
You're listening to Real Estate Today with Yvonne Candy.
Well, I understand that a credit card is worth so many points on your credit report. A secured loan is worth so many points. Let's say a store is worth the least, but so many points. Can you give us a little bit more information about that?
I can't because of FICO keeping that secret, they don't tell you how many points. So every report that I look at with scores is different. I will tell you sometimes I am stumped. I may have a client that looks like they have a perfect credit profile and they've done everything right, and yet their scores are maybe in the mid-sixes, whereas I'll have somebody who has maybe a lot of collections, the credit report doesn't look as good, and they could be in the 700s. So because they don't reveal that algorithm, the only way you can get an estimate, at least in mortgage world, is if the mortgage company is using a simulator. Some of them have simulators that seem to be pretty close to FICO. So it will say, if you do this, if you add a secured card or you eliminate these collections, it'll give you scenarios. And then based upon that, it'll tell me, okay, here's what I got to work with, with that particular client on. So really, I hate to say, it's really a guessing game. It is a game that doesn't have rules that are given to the public.
Mm-hmm. Yeah, I've seen that. Yeah.
It's like if you're going to play football and I said, hey, no rules, here's the ball, put, however many players on each side, and you got to get it there and you got to get it there. But, each person didn't know what their job was. There's no teamwork. Well, that's sort of like credit. It would be a good comparison.
I've heard a lot of credit repair people say, the reason why you shouldn't spend time on store credit cards is because they only contribute about 5% or 10% to your credit score. And then a major credit card contributes about 35%, which is about the same.
I haven't heard it. But
have you heard it?
Yeah, I haven't heard it, but that makes sense. But no, I have not, but that actually does make sense.
Mm-hmm.
Because a major credit card would carry more weight to a lender, a MasterCard, a Visa, Discover, American Express. To me, those would carry more weight because they're bigger companies that have been around longer periods of time.
So in other words, people, don't waste your time on the store credit. If you're going to get a store credit card, like, what were we talking about? Macy's? We were talking about,
we were talking about Macy's years ago. Yeah. Well, all the companies. I mean, you can walk into any department store nowadays, and that's what they ask you when you're, going to pay for your purchase. Oh, do you want to apply for credit? Oh, every Wednesday, if you use your credit card, you get 10% off. They've already calculated out the statistics, so they already know how much they're going to make on you. That's the key thing. They already know. But you, as the consumer, you don't know unless you keep really, tight reins on your finances and you know what you're paying in interest rates. I mean, I have interest rates that are so low you just wouldn't believe it if I told you. But it's because
with
I
your
have
credit score,
the
sky is the limit, Laurie. You can make yourself a multimillionaire like 10 times over with your credit score. No, I'm serious, because the opportunity is there for you to take that credit score and actually make it an investment in yourself. That's what you can do with good credit.
Right. Right. I mean, for most people, you want to have good credit just so that you can get those low interest rates and that you can qualify for it. For me at this level, it's almost like a game. I can only play with my own credit. I can only do things with my own credit. And I am very protective of my own credit. So I'm, always checking it to make sure that everything is in order. And if something is not, obviously I know what to do to take care of it.
For those people out there that is trying to build their credit, and also I would say trying to influence their poor credit with putting good credit on their credit report. How do you get secured loans? What's the procedure? Because they're worth a lot of points. They contribute a lot to your credit score.
Well, if you're talking about going to your bank and getting a secured loan, okay, again, here's the tricky part, because they're going to pull your credit. It's going to be a few points off. To qualify, you're going to have to be at a certain level score, so you could still be denied. Now, the only time it makes sense to me really, like if someone has very high interest credit cards and they can't get them lower, they've already called. But if they're able to qualify through their bank or credit union for a lower interest, loan, what they can do is they can pay off the credit cards with that loan, because now they'll be paying less interest. But the key, Yvonne, is not to cancel those credit cards if they have a perfect payment history. You want to still keep those credit cards. You just want to pay them off at a low, at a lower interest rate.
Now, this is what I've had a few of my clients do in the past, is just go to their bank, like say if they wanted to get a personal secured loan, and they can do that with a savings account or a CD, and they put the money in a savings account or a CD, and in return, they would give them the loan. So they would be actually getting the money back. So they would bring the money to the bank. The bank takes the money, put it in the account or a CD, and then after the loan process, they turn around and they give them a check for the loan. So they actually are giving them the money back. So the thing is that there aren't a lot of banks out there, which is a good thing, that run credit report, because these are some sort of, they call them credit builders or whatever you want to call them, secure loan accounts. And they don't really run the credit. What they do is they just fill out the paperwork and do it right there. The only thing you need to know is, of course, like we were saying before, do you report to all 3 credit bureaus? You want that.
Right.
You want that.
Exactly.
But it holds a lot of weight on your credit report. It contributes more points than a store. So it's very important to get those. And my listeners, I want them to understand that. It's very important to add the personal secured loans to your credit profile along with your MasterCard and Visa. Laurie, what do you think about using third-party trade lines for building credit?
I think it's very risky. It was a big thing back in the early 2000s, until the bubble burst, and now, of course, it's come back. If you're going to a company, basically a third-party company, and they will charge you, I'm talking thousands of dollars, to be added to some total stranger's credit line, because seasoning means how long they've had it. So a seasoned trade line could be 5 years, could be 8 years, could be 10 years or more. I think it's extremely risky, because if you are the person, if you, Yvonne, were authorized on my credit card and we don't know each other, we've never spoken to each other, there's a third party company in between, that's obviously making money on this. First off, for me, it's a huge risk, because even you could find out the complete account number, and you could get on the phone or go online and order things, and you have no liability whatsoever as an authorized user, whereas I, as the card holder, do. So for me as a card holder, it's very risky. Now, for you, if I made a late payment and screwed up my Seasoned Perfect credit line history, and that in turn, when it dings me, is going to ding you. So I am not one for that. It's one thing if you are an authorized user. Usually it's on a family member, or a significant other, someone you're in a relationship with. It's less risky in that respect, and that you obviously know the other person and they're giving you permission to do that. The only other way is to become a joint card holder. Now, that's usually husband-wife, but doesn't have to be. Joint card holders are equally liable on the credit card. So, in the event of divorce, the judge can't say to you, "Oh, you can't split that credit card, that credit card number they've assigned to you in half and give it to one half to the woman and one half to the man." Because you're both liable, the credit bureaus will put that on both of your credit reports. And usually one person hates the other more and won't pay, so the other person gets stuck with the entire bill. Otherwise, they're going to miss the payments and it's going to destroy the credit. So that's why authorized, you have to be in a good permanent relationship or with some type of written agreement, if you're going to do that. That's my feeling on it. But to go to a third-party company, no. That to me spells danger, red flag, bad things coming down the road.
I agree. They actually pay people for using their good credit. It's very interesting. I would never use them.
And think about this. If you purchased a seasoned credit line, the partial account number is going to show up on the credit report. It is going to show up partially and the name of the company. It will show up.
Right.
And so that for someone who of a criminal mind, that would be an easy way for them, because now if they spend all this money on your account, you can't go back to the credit card company and say, they're not on my account. The credit card company is going to say, well, wait a minute, you authorized them to do so. So that to me is so dangerous. And I can tell you, I've been approached by companies, about doing the same thing for other people. Oh, you could make $5,000 if you'll let us, add people on as an authorized user. And I think, no way. I worked hard to get to where my credit is. Why would I risk it? And the funny part, here's the part where you'll laugh, most of these seasoned trade line companies, what they do is they actually use the credit bureaus. They can market using the credit bureau's information, because each bureau can sell lists. So I am probably on a list of people who have a high credit score, and then these companies will market to me saying, "Hey, you'll make it this much money." And I think, no, sorry, not going to happen.
Wow.
It's too dangerous. Don't do it. Don't do it. Don't.
So, Laurie, what do you consider a poor, fair, and excellent credit score?
Well, my opinion might be different than that of others, but I will say, to me, poor would really be anything, I would say 640 or less, I think of as poor. Anything that is where you're considered platinum, really good, is 780 or higher. So the median is between that 640 and that 780. So most people probably fall, I'm going to just guesstimate here, probably in the high sixes. I think it's usually around 680. That's about average.
Right. That's considered fair as far as I understand. Good, but
right.
Fair. A fair good.
Yeah, exactly. Exactly.
Now, everybody remember, Laurie does not do credit repair. She does credit consulting, which means she shows you and helps you with the credit repair process. Laurie, tell everyone how they can get in touch with you.
Sure. They can go to my website, which is crediteducationconsultants with an S at the end.com, or they can reach me at 813-500-6064, and my email address is consumercreditteacher, all one word, @gmail.com.
Thank you so much, Laurie, for coming back on the show.
Thanks so much for having me.
You've been listening to Real Estate Today with Yvonne Candy. Don't forget to visit us on Facebook, Twitter, Instagram, and all other social media.